session, I'm going to talk about the asset pricing models. And though there are a couple of important asset pricing models, I would be more and more focusing on one of the very popular asset pricing model called capital asset pricing model, or CAPM in short. If we look at any of these asset pricing models, their main objective is to get into the absolute pricing of the security, right? They help us in determining the true price or the absolute price of the security, or they help us in terms of valuing the assets where majority of the assets have uncertain cash flows, both in terms of amount or in terms of timing. So where the cash flows are very much uncertain, which means where there is a risk that is built into the cash flows, if I have to really value those particular assets in combination with their risk or based on the assessment of their risk, if I am getting into the valuation of the assets, there also the asset pricing models come into picture. And just theoretically, to give you some kind of an insight, there are two major, I'm just saying major because there are so many other asset pricing models also in place, but one is the capital asset pricing model, which I am going to deal with now, and we also have another important model, arbitrage pricing theory, which is built upon the CAPM model, but conceptually I'll give you what are the kind of differences that exist between the two. So they have some set of assumptions different, right? So, but these are the two commonly used models for typically pricing the assets. And one more important point before we move even more further in this is we have to understand the concept of relative pricing. The relative pricing concept says is whatever is the risk, right? When I am talking about a risk of a particular security, the risk of that is already bundled into its price, right? So more risky security should attract more price, or should be sold for cheaper because there is a high risk that is involved in it. So the return that it should give is much higher compared to a low risky security. So the risk is already bundled into the price. That's what the relative pricing concept talks about, which means once I do the pricing of this security, any of the assets that are derived from this, right, that is what we call as derivatives. Any of the securities that are derived from the original security, so the risk does not play any kind of additional role because the risk is already bundled into the price of the original security itself, right? And as a part of this session, what I am going to look at is the return of the assets. Whatever each asset or portfolio I take up, I am looking at the return of the asset versus the risk. How do I link these two elements? How do I measure the risk of the security or the portfolio? How do I measure the return? And what is the kind of linkage that is existing between the two? So we'll get a data from the markets, right? What all kinds of data that we require is something that I would be talking of, and we would also be getting that kind of a data. And once we have the data with us, we really need to model the dependence between the return and the risk. Now this is where I would be using the concept of linear regression. Linear regression is a kind of a concept that will build the relationship between the return and the risk, and on the top of that we'll perform some hypothesis tests to really assess the significance of the result, right? So this is what we are going to deal with. So we'll get the data, and based on the data we will try to compute the CAPM, the capital asset pricing model for a security. So before we start the computation process, let's try to understand some basic theoretical aspects regarding the capital asset pricing model. First of all, it uses economic considerations based on the various economic factors this model is derived. The formula has lot of assumptions, right? Some of them are realistic, some of them are not. It says the individual investors are price takers, right? As an individual investor like me, I cannot influence the price. I have to buy or sell my asset at the price the market decides for me. I'm not a price influencer, I'm a price taker. And it makes an assumption that all investors have a single horizon for investment. So there is nothing called short term, long term, all of them invest. You, me, everyone invests for the same time period. Probably it looks like something to question, but yes, when this model is developed, these are some of the assumptions that have gone in. And whenever people are investing, that investment is limited to those securities that are traded. So the assets which are not traded, it is assuming that there is no investment in them, which may not be true, right? Some of the assets may not be traded at all, but some investment has gone into those assets. But CAPM assumes that all the investments are typically going only in those assets that are traded, which means in another way, if I have to put, every asset in which some investment has been made, it is traded in some form or the other. Then it's also making a few assumptions. There are no taxes and no transaction costs, which is a very ideal world which we are not operating in. And then when it comes to the information about the various assets, various companies, performances, it says that the information has no cost. Information is freely available to every investor. In reality, it is not. Some information is very, very expensive. But though these are the kind of assumptions that have gone in while developing a model, even today this model has been a very popular model for pricing the assets, in spite of all these assumptions that have gone in. And when it comes to investors, it assumes that all the investors are rational, and everyone goes with mean variance optimization. We have looked at the portfolio optimization framework, so where we are optimized on the mean return versus the risk that is involved with the portfolio. It assumes that every investor is rational, and for them mean variance optimization is the model for investment. And in that case, everyone will invest in the same portfolio, and that is what we are calling as the market portfolio. So everyone will invest only in that combination, and all other combinations will not be invested. And it also says the expectations of each of the investors are homogeneous. Every investor has the same set of expectations regarding the mean, variance, and all the other properties of the asset. There is no difference of opinion among the investors, right? So these are all the assumptions using which the CAPM model has been derived. Now, this market portfolio is something when the investors are rational and when their objective is to optimize the mean versus the variance. Every investor is